And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is the 1st of November. If this was next year, tomorrow would be Election Day. But 12 months till Election Day. That's where we are right now. So just going to wrap up. And of course, we've got a lot of stuff going on today. Federal Reserve having their two-day meeting started yesterday. Jerome Powell set to announce this afternoon. And of course, this is going to be the big, what's he going to say, right? Is he going to talk about higher for longer? Is he going to talk about needing to hike rates more because of the recent strong employment report? I suspect that we are not going to get much of a different speech than what we just saw 2 weeks ago when he gave his speech to the Economic Council, as we said, last week. So, probably not a whole lot of change. And that is simply that, we're watching the data. The data is still strong. We might need to hike one more time. They're going to leave that out there. Whatever they're going to say, they are going to leave out that possibility. They're going to leave that possibility of one more rate hike on the table, because if they take it off immediately, markets are going to rally on expectations of rate cuts coming sooner rather than later. And that's just what the market's hungry for. The market's hungry for a return to monetary accommodation, reversing QT, going back to low rates. That's what the markets are begging for. And again, so any type of hint that that is what the next steps are going to be is going to lead the market to rally sharply, which that would be great. But that potentially fuels inflationary pressures because you start to increase consumer confidence. That's the thing the Fed does not want right now. So again, don't expect a whole lot of change today. They're not going to hike rates. Futures are pointing down a little bit this morning, not surprising. I've had 2 good days of a rally here, so we had that good kind of follow through. We're going to talk a little bit more about that here in just a second. But overall, as we take a look at, the economic data, it continues to be okay. But again, there's this bit of divergence that's going on between economic data like the ISM manufacturing indexes or the Chicago index that came out yesterday, the Purchasing Managers Index that came out yesterday. If you take a look at things like the Chicago Fed National Activity Index, which has 85 indicators in it, they don't suggest the type of strength in the economy that we're seeing in terms of the employment data. And so that's one of the dichotomies that's kind of going on currently with the data. There's a lot of this data that suggests the real economy, what's actually going on, is a lot weaker than what the employment data says. So again, this is always the challenge with economic data looking forward, is that you get these data points that don't necessarily agree with each other. But unfortunately, the Fed is kind of driving policy based on employment and inflation data, which are subject to very, very big revisions down the road. So this is one of the risks for the Fed, and one of the reasons that they often wind up making a policy mistake is because of that data, that lagging data that they're working with. Real-time economic data suggests a much weaker economic environment. But again, we'll see how this kind of plays out. Good news yesterday, by the way, if you are looking to buy a home, when you buy a house, you have to pay what? What do you have to pay, Brent, when you buy a house? Commissions.
Oh,
right?
yeah.
Yeah. Got to pay those commissions. 6%, 3% on each side, right? So it's not cheap. And I've said for years, I go, how is it that realtors, for the little bit of work they actually do when they buy or sell a house, get paid 6% on commission when, people like us, we manage money, consistently under pressure from competition. So how is it that this commission is stuck at 6% and competition, right, doesn't bring it down? Right? And what we found out yesterday, a jury has now slapped the National Association of Realtors, Warren Buffett's real estate company, and several others with a collusion and antitrust violation, $1.8 billion. That could be trebled to over $5 billion in fines for colluding to keep commissions high.
Whoa.
So, good news for buyers. Yeah. We may now see competition because of technology coming in to lowering the cost of commissions on buying a house. So, that's one thing. So, if you can back off that commission, you can also lower the price of homes. And one of the big problems that people have had as of late, of course, is the issue of affordability. So this is a step forward that may make things more affordable. Of course, the National Association of Realtors, I've called them the mafia for a long time in real estate because, but they're also responsible for a lot of these, kind of endeavors to, shove people into higher priced homes and keeping home price elevated, that type of thing. So again, they are not blame free for our housing problems at all. Okay, here's what you need to know before the bell this morning. I probably just made a bunch of realtors upset this morning. Sorry. It is what it is.
No doubt.
So markets rallied over the last couple of days. Look, we've had a very, very big decline in the market, and we've had 3 months of negative returns. Now, this is important because we are now moving into the last 2 months of the year, which, of course, suggests that you're going to see a stronger rally into the end of the year. And again, we've talked about this before. You've got, starting today, that window for stock buybacks is open. You also have in the month of November a lot of seasonality in terms of purchases for equities. Again, we've got a lot of performance chasing that has to be done by the end of the year by managers, and there's also a very big short position against equities as well sitting out there. If the market begins to rally, they're going to have to cover that short, which adds additional fuel to the market. So again, there's a lot of reasons why you should expect a rally here, and just from a technical basis, you have a very large number of stocks trading below their 50-day moving average. Now that percentage of stocks below their moving average is at levels that normally coincide with stock market bottoms, either in bear markets or deep corrections. And of course, we've had a fairly deep correction here. We talked about that 10% correction back in June. That's exactly what we saw. So, that we're at that level where now you normally get a bounce within the markets. Importantly too, when we take a look back over time and we look at periods where you've had 3 negative months in a row, that doesn't happen very often. And again, normally you'll get 1 or 2 months and you'll have a month of gain, those type of things. But, you don't normally see periods where you have 3 negative months in a row. In fact, the last time that you had 3 negative months in a row was in 2020 during the pandemic-driven shutdown. You had 3 negative months in a row, and that was a fantastic buying opportunity for stocks. So again, you've had 3 negative months consecutively in the markets. That is a rarity that doesn't happen very often. It can happen, but it doesn't happen very often. And this was also one of the premises why in June and July we were talking about needing a correction, because we had basically 6 months of an advance in the markets. That's also a rarity. That's a very long stretch for an advance. So markets can't go up consecutively month after month after month after month without having a correction. They also don't go down month after month after month without having at least a reflexive action in the markets. And again, you can have a period like we saw in 2022 where you have an overall decline in the market, but along the way you had 2 months down, a month up, month down, month up, that type of thing. So the point is that you're due for a rally here. Now, it doesn't mean that because you say you're due for a rally that you're going to have 6 straight months of advance, right? You're at least going to have a month or 2 of this market gaining some ground before the next correction. And again, so it's just, people get too far off on one side of the ledger. Lots of negative sentiment right now. People are assuming the world is coming to an end. That's a great setup for a reflexive rally in the market. So just kind of keep your mind open to that a bit. That's what you need to know before the bell this morning. When we come back, I'm going to get joined by Danny Ratliff. We'll talk about why this correction has been so confusing for investors. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Is this the Butterball Turkey Hotline?
No, Janet, this isn't Turkey Talk. It's Talking Turkey. Our next Candid Coffee, Saturday, November 4th. Richard Rosso and Danny Ratliff will take your questions about the beefs you've had about money this year and the personal finance pitfalls that really cooked your goose, and some end-of-year money ideas to prepare you for 2024.
Beef? Goose? I thought it was turkey.
Register now at realinvestmentadvice.com. Talking turkey about your money with Ratliff and Rosso.
Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. Danny Ratliff joining me as well. Good morning, Danny.
Hey, good morning, Lance.
Back from the Great White North.
Yes.
He survived.
Survived. I'm here.
So where'd you go?
New Mexico.
No, so it wasn't really Great White North, but it was.
It was a heck of a lot cooler than it was here, so it was a nice change of pace.
And then you come home, you bring the cold with you, I see. So.
Yeah, I know. You know, the funny thing is about it's much colder as it was at 10,000 feet than it is here. Like, this weather here, when it gets cold, like, we can't win.
Right.
It felt colder here the last couple of days than it did there because of the humidity and, whatever else we had going on. But, yeah, I'm not complaining.
That's good. But you had a good time.
Yeah, it was great.
Did y'all get anything?
Did.
What'd you get?
An elk.
Nice.
Yeah. So it was nice. We'll have meat here for the next year, so that's always a nice thing.
Well, see, there's your inflation solution right there.
It is. It is. I got to do the math, though, cost of gas, everything else, and see exactly. But, yeah.
Yeah.
I like to tell myself it's much cheaper.
Yeah. It justifies, paying for all the equipment and everything else.
Yeah, exactly.
It works itself out.
Exactly.
So, of course, as I said, today we've got the FOMC decision this afternoon. Nothing's going to change there. Today we've got the job opening and labor turnover survey. Friday we have the employment report. We have the ADP report tomorrow. So the Fed knows all these data points. The Fed already has. So there's nothing that's going to occur over the next couple of days that the Fed doesn't already know. So they're going to talk about strong jobs or whatever it is. And as I said yesterday, the one thing to kind of pay attention to is if they happen to come out and say something like, and again, when you look at the statements, what you're always looking for is what wording did they change? It's always the same statement. They just change a word here or there. So if they happen to say something like, we're seeing some moderating in the jobs, something like that, that would suggest that Friday's employment report is probably pretty weak, considering the last one was very strong. But I don't expect them to say that. It'll be, jobs are strong, the economy's doing fine, nothing's here. We're focused on inflation and bringing that down to our target rate. Again, I wouldn't expect anything different at all. Airbnb today, DoorDash, CVS reports the earnings this morning. Yum Brands, Yum Brands is interesting just to see how inflation is impacting fast food. Roku, Estee Lauder, GlaxoSmithKline, Electronic Arts, Cheesecake Factory, Zillow, Humana, just again, this kind of long list of stocks today. Tomorrow, I believe, is Apple. Tomorrow's Thursday, right? Yeah, tomorrow's Apple. So again, just we're getting through. By the end of Friday, we'll have been through about 80% of all the S&P 500 will have reported earnings. Earnings season has been okay. It has not been absolutely stellar, but it's not been terrible. Beat rates are over 70%. Not surprising. We lowered earnings dramatically getting into this quarter. The interesting thing is that forward earnings are getting brought down now already. So we're starting to see those forward estimates that were very elevated. We're starting to see those come down a bit. Maybe not quite as much exuberance about the recovery in earnings going into next year as well. They're still expecting higher earnings, right? Just not maybe as egregiously high. So, but that should be expected. That's how we always do these things. That's when we call it millennial earnings season. So there we go.
Well, Yum just reported, and they said they see softer demand in Q3. So
there you go.
Yeah.
I mean, look, I was just talking about this yesterday. You have young kids, but it's expensive now to even go eat fast food. What used to be cheap fast food is no longer cheap. It may be fast, but it's no longer cheap. It's to go out and eat is, even just for my wife and I, we go out to eat and it's just like, hey, let's go grab something fast, quick, healthy type thing. It's like $50-$60 now. I mean,
it's not cheap.
Yeah.
I mean, we split a lot of meals. We have the kids, and now they're beginning to eat us out of house and home and require their own meals, which is a change. Like, let's see how we can do this a little bit better. But we're always trying to save a couple bucks. In fact, last night I tried to bargain with the kids on their Halloween candy. Like, I remember. So I've screwed up here. We've gotten soft.
Yeah.
Because I remember my dad be like, I need to check these for razor blades or something crazy, right? And then you'd never see the candy again.
Yeah.
Where now my kid's like, I'll sell you my candy. And I was like, all right, I'll give you $20.
See, you did it wrong.
No, I know. I did it way wrong.
Yeah.
I'm not sure how this happened.
I will tell you how I did it.
How?
I taught my kids about income taxes.
Well, no. There's a tax they have to pay.
Okay.
Yeah. There's a tax. But
30%.
Yeah.
That's...
But
it was all the good stuff. It was Reese's and peppermint patties and those things. That was the tax.
That was gone. Yeah.
They got left with the goobers and the airheads and
The tribute.
Well, my kids are even feeling inflation because I feel like I could buy it for like $5-10 back in the day. And they're like, I was like, I'll tell you what, $20. You guys got a lot of candy. They're like, 50. It's like, no, I'm not going to have. I said, here, how about this? You guys get to pick 20 pieces you can have over the next year, and I'm going to take the rest. Put it somewhere else. So that's where we're at. We've got 3 big bags, and they have their little Ziploc bags of what they're going to keep that, the show may or may not allow them to have over the next, several
we were
months.
talking about this yesterday, how the younger generation is ruining Halloween with, the witch that comes and swaps out the candy for a toy and that type of stuff. Just, no. Stop
Swaps
that.
out the candy with the toy?
Yeah.
Oh, you're talking about like the people
It's
handing...
the Halloween witch, and she shows up and she takes all the candy and then she leaves the toy in its place.
Huh.
Stop ruining Halloween, people.
I mean, at least she didn't leave like a banana. That bee would probably go on at our house. Here, kids.
I did have some very creative costumes come by my house last night.
Did you?
So, yeah. We're not going to talk about them.
Okay.
But they were very creative. Not on there.
Yeah, not appropriate.
Had some very creative teenagers. So...
Well, that everybody gets upset about teenagers still trick-or-treating. And, I talked to somebody about it the other day. And they're like, you got to think about it the other way. They could be out doing bad things or, getting in trouble. So they're like, I'm not opposed to it. So I get it.
Yeah. This is all fine.
But dress up.
You have to dress up. Yeah, you can't come up to the house with just your normal clothes on. What are you dressed up as? Teenager? No, that doesn't work.
Yeah, James wanted to dress up as a Astro baseball player. And I'm like, well, that's fine. But you got to go all the way, right? You got to put a whole... put a jersey on, put a hat on, and wear baseball pants. And, he's like, he wanted to wear like shorts. I'm like, this is what you do every day. This is, you play baseball. You're not, you're not doing anything real creative here, buddy. He was Ryan Presley from the Astros closer.
And your daughter?
And so he put a beard on and he got a tattoo sleeve because he has a tattoo.
Right.
But I was like, well, it's still not super creative, but,
Yeah.
maybe an A for effort.
Okay, so what'd your daughter go as?
A cockroach. Cockroach. Yeah, Michelle hates cockroaches. One of her friends, her mother hates cockroaches as well. And so they decided to harass their mothers, and they were cockroaches. So Michelle did find a cheap coverall outfit that we wrote Exterminator on the back and Roach Patrol on the front. And so that's what I went as.
Yeah, somebody should have dressed up as a raid can.
Yeah. Well, I forgot the big, the bug sprayer at the house, or we would have, to complete the costume.
Right.
But yeah, so that, and we had a zombie.
Nice. One of my favorite ones, I will tell you one of my favorite ones was I showed Danny this morning. It was a video of a teenager dressed up as Joe Biden, and two of his buddies were dressed up as Secret Service, and he would walk down the street and fall over.
Oh, kids these days. Where do they get that stuff from?
Don't know. All right. Well, look, we pretty much wiped out a segment here. Did want to talk a little bit about what makes this market correction so confusing. And it was kind of an interesting article this morning in the Wall Street Journal. It said, even if the recession, this is the tagline to the headline, what makes this market so confusing? Even if a recession is on the way, it is a poor explanation for the stock market slide. And I think that's an interesting point because maybe yes, maybe no. Because if you're expecting a recession, right, that would translate into lower earnings because you have slower economic growth. And the consequence of that would be a repricing of valuations, right, because valuations are a function of price times earnings. So if earnings are going to come down, then I have to reevaluate price relative to earnings, and we currently have pretty elevated valuations. So, you know, the market decline as of late really, you know, shouldn't be that you know, shocking if you're expecting a recession. But I think more importantly right now, and I want to get into this article, you know, after the break, Danny. But, you know, it's interesting, and I said this back in June. So back in June, I wrote several articles talking about we're going to have a 5 to 10% correction. You should expect that. And then one thing we even talked about here on the show is, hey, when this correction comes, be aware because everybody's going to get super bearish. And it's going to be like, oh, you know, this correction is terrible. We're back in a bear market. You know, the bull market's over. You know, it's the end of the world as we know it, to tag a line from REM. But, you know, I said this was going to happen, right? And so here you are. You've had a 10% correction, completely normal within any given year. And now you have everybody super bearish, and you know why? You know this is a recession that's coming, and all this. I'm not arguing a recession isn't coming or not. I'm just saying is that, you know, this is psychology, this is emotions. We talked about this over the last couple of days, probabilities versus probabilities. You know that this is what happens during a decline. During the advance earlier this year, everybody couldn't wait to get into the markets. Now you can't. Nobody wants to be in the market, so you've got to be able to kind of suffer the slings and the arrows of the markets if you're going to invest over time, and you know understand that these corrections, they happen on a regular basis, and then you're going to have another advance. So the problem is going back to what we always talk about before. You got to be careful that you're not buying high and selling low by letting your emotions kind of rule the roost. But we'll come back. We'll talk about what the Wall Street Journal said, why this is been a confusing correction. So don't go away. More with Danny Ratliff right here on The Real Investment Show.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Is this the Butterball Turkey Hotline?
No, Janet, this isn't Turkey Talk. It's Talking Turkey. Our next Candid Coffee, Saturday, November 4th. Richard Rosso and Danny Ratliff will take your questions about the beefs you've had about money this year and the personal finance pitfalls that really cooked your goose, and some end-of-year money ideas to prepare you for 2024.
Beef? Goose? I thought it was turkey.
Register now at realinvestmentadvice.com. Talking turkey about your money with Ratliff and Rosso.
Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife is the worst when it comes to Tupperware. She can never put the Tupperware lid on the actual container when she puts it away, so we have this drawer that's a hodgepodge of just Tupperware bottoms and Tupperware tops.
The Real Investment Show podcast. Same show, your schedule.
In the back of this drawer is the lid that goes to this particular container. So I reach in very quietly, I get it, I put the lid on it, and I walk out of the kitchen. By the time I get to the living room, I hear, aha! And she's got this piece of saran wrap off the wrapper. Now it's all like mangled up. The edges are all ragged and it's all wrinkled in the middle and it's kind of stuck together. And she's holding up. She's so proud of herself. She turns around to put it on the container and it's sitting there with the lid on it.
The Real Investment Show podcast.
And then came the string of profanity and the saran wrap came throwing out of the kitchen at me.
At realinvestmentadvice.com.
I did nothing. I just put the lid on the container. Anyway, I'm filing for husband abuse.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Danny,
Yes.
what are you doing Saturday?
Oh, I got a little bit of work.
Yeah, I think you do. What's going on?
So, Candid Coffee this Saturday. Go sign up realinvestmentadvice.com. Turkey Talk. So, just talking about what's going on in the world, markets, economy, financial planning. So, we are taking questions, realinvestmentadvice.com. Go sign up. Please give us questions you may have. We will try to address it. We try to keep it right at an hour, 8 a.m. Central Time this Saturday. What is that, November 5th, Brett? 4th.
Yep.
Yeah.
November 4th. Saturday, 8 o'clock. The banner's on the website, so if you go to realinvestmentadvice.com, just click on the banner and get registered, signed up. It's Zoom, right?
It is a Zoom.
It's Zoom. So there you go. So
It'll be Zoom. It'll be live. It'll be fun.
there you go. I'll be sleeping. Not
No, you won't.
I know.
We know better than that.
I'll be putting out the newsletter. So a former editor of The Economist magazine explained the craft of journalism as simplify then exaggerate. I love that. That is so true. If you take a look at the media today, particularly with journalism used to be a function of actually reporting facts, and that's gone out the window.
Used to be simplify
Decades
and
ago.
explain.
Yeah, now it's simplify and exaggerate. So the stock market correction as of late certainly offers plenty of opportunities to do exactly that, and we've seen a ton of that. Market corrections coming because, everybody's selling treasuries or, it's World War III on the cusp, and there's tons of things to worry about. And as we, discussed yesterday and as we wrote about in this past weekend's newsletter about probabilities versus possibilities, these extreme tail events generally don't occur. Can they occur? Absolutely. Right? Nobody expected a depression to occur in 1929, or a market crash, then a depression. Nobody expected that, but those are those tail events that can occur. They just don't happen that often. So if you're betting on one to occur, generally more often than not, they don't happen. And if they do, it really doesn't matter anyway, because everything else is so bad, it doesn't matter, whether or not you've got money or not. So if you're betting on World War III, it's not going to matter. You better have lead and a lot of it. So, in fact, I just put a new order in last week. So,
well, Lance, we were talking about what makes this market correction so confusing. I think it's not just confusing, but probably frustrating for most, because what's led up to it, albeit indexes are up a bit, it's not treated equally, right? We talk about, like, if you look under the hood, you see, wow, a lot of these companies aren't doing as well, and so most people didn't participate fully unless you're invested in the Qs or just straight in the index, which many people aren't, especially coming out of the year that we had last year. Then bonds have not been working, which I think we're probably getting much, much closer to seeing. It seems like 5% is kind of that magic number where a lot of people are willing to jump in, and maybe yields don't get much higher than where we are. Most ECBs, they've indicated they've hit their terminal rate. Bank of China, United States, probably pretty close.
Yeah.
We may have a little bit left, but probably not much. So I think it's frustrating because they say, well, listen, we haven't participated on the way up, but then on the way down, we still have, we're seeing portfolios decline because rates are rising, markets have pulled back. And I think a lot more people are inclined to say, hey, you know what? I'm going to move into more fixed income, maybe at this point, than what they have been. I'll find a CD. And, I'm hearing comments like, hey, we could just go get a CD. We could have gotten 5% all year. Well, no, we couldn't have. I mean, earlier in the year, we were getting 3%, maybe 4%. Now we're getting much higher yields. And so locking in, I think, is great, but we also have to be careful with, number one, reinvestment risk if we're looking at short-term debt. And then number two is, look, we can, just because we want or we think something's going to happen does not mean it will, or it will happen within that specified time frame. So we have to be cautious with kind of all or nothing strategies in this environment. And I think, with we always want to rationalize every market move. And sometimes that's extremely difficult.
Right. And again, this has been one of those years where, when you look at just the S&P, right, just as a whole, and say, okay, well, the S&P's up 7% this year, I should be up 7%. No, and again, no. That's because of the outsized gains that were put in earlier this year by 7 stocks, essentially because the equal weighted index is negative almost 5% for the year right now. So, there's a vast differential between what's happening in 7 stocks versus the other 493. In fact, right now, we have a near record low of stocks trading below their 50-day moving average. That only occurs at bear market bottoms and deep corrections. So again, you have a lot of stocks that are trading well below their 50-day moving average, which isn't, normal. And you're going to get, that type of action. But again, this is why it's so confusing, because you have this headline on one side, which is the S&P index up 7% for the year. It's great. But the vast majority of markets are not up for the year. And that's kind of a huge part. And, the other side of this too is that, people don't realize we haven't seen a record high on the index since January of last year. And we're still not anywhere near a record high. So, we haven't had that big 50% correction that everybody was expecting. But, we're in this kind of grinding period of markets just kind of trading sideways for almost 2 years now. And that's frustrating on a lot of fronts. And that's what leads to a lot of investment mistakes over time is, you've not had any return now in 2 years. That's from the market. So again, you have to, and that's the S&P. So that's even with the cap weighted indices. So, that's the environment we're in. And that gets frustrating. It's like, I'm not making any money. Well, neither are the markets. So you've got to get through this period, though, to get back to a period where you can make money.
Well, I think you've got to take in consideration, too, how money actually works versus the index, which is a little bit different in the sense that we may look at it and just, follow the line in the chart. But also if, we're down 10%, how much do you have to make just to get back to even? If you're down 20%, how much do you have to get back to get to even. And I think that's where, markets will go on in perpetuity. They can take somebody out of an index. They can put somebody back in. Company goes under. They just replace it. Where money doesn't work that way.
Right.
And I think that's what's always difficult. And we've talked about this before. It's kind of interesting. Like we'll visit with people and say, well, hey, I've made 7% over so many years. Why is my money not doubled? Looking at the Rule of 72. Well, Rule 72 requires that we don't have volatile returns. It assumes a fixed rate of return, which we just don't get out of markets.
Right. Yeah. No, this is the hard part. It is interesting right now, though. We're seeing a lot of signs that, we're going to have a recession, or we think we should have a recession next year. Higher interest rates, spreads on CCC junk bonds are now about 10 percentage points over the Treasury. So that type of increase in junk yields is often a good pre-recessionary signal. But again, there's not really any evidence right now that that's going to be the case. If you take a look at manufacturing indexes, they're recovering. The ISM Services Index back in expansion mode. Employment still remains strong. So again, there's lots of trailing data we can look at that says, hey, there's no real sign of a recession coming. But again, we have a lot of indicators that suggest we may get into one next year. We'll have to navigate that when we get there. But, the markets are navigating that risk to some degree. And so part of this correction that we're in is kind of, again, it's reworking these valuation issues relative to what's going on economically in the overall economy. Yeah, consumer spending, those type of things.
And it's frustrating because we've had these economic indicators suggesting that recession for 2 years now.
Yeah.
I mean, we've had an inverted yield curve. We've had poor participation. We've had a lot of the things that we watch for. Leading economic indexes continuously negative. What are we, 18 months?
Right.
I mean, there's a lot of things that the Fed looks for that would suggest that we're slowing down. Now, the differentiator compared to this time versus many has been the amount of stimulus that has still been out there. Inflation Reduction Act, now we're seeing spending coming from that. So this can push this on, and I think people get maybe a little atrophy from this. Yeah. They're just tired, right?
Yeah, they're worn out.
Yeah.
And again, we talked about this yesterday. Again, this goes back to the article from this weekend where I had this bell curve of outcomes for the economy. And we talked about this yesterday is that, when you turn on the media right now, it's just nothing but bad news. I mean, and this is every day. It doesn't matter what channel you watch. It doesn't matter what time you watch the news. It's just always bad news. It's just this constant barrage of depressing state of affairs within the economy. The economy sucks. We've got war. We've got this. We've got that. It's terrible. It's hard to even get out of bed in the morning. But that's where you've got to start setting this stuff aside and going, look, I understand that if it bleeds, it leads. Nobody wants to hear good positive news, right? Little Jimmy hit a home run this afternoon in his fifth grade baseball game. That's awesome news. Nobody cares, right? But that's the thing you've got to set aside and start focusing on the fundamentals and the facts that drive things over time and try to get out of this spiral of emotional bias that you get from watching the news, watching the headlines, watching the media. And that's a hard thing to do in today's world. Too much social media, too much headline news, too much garbage running around, and just lots of bad opinions in general. Focus on the facts.
So you were asking about my trip last week, and I think the best thing was no news.
Yeah.
Honestly.
Yeah.
Like being able to separate from that, and then the moment you get back into civilization where you can actually get internet once again, you're like, oh, well, I didn't miss that so much.
Yeah. My wife and I had that same conversation.
Yeah.
Just recently.
It's therapeutic. So, I highly recommend it.
All right, quick break. We'll be right back. Wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Is Is this the Butterball Turkey Hotline?
No, Janet, this isn't Turkey Talk. It's Talking Turkey. Our next Candid Coffee, Saturday, November 4th. Richard Rosso and Danny Ratliff will take your questions about the beefs you've had about money this year and the personal finance pitfalls that really cooked your goose, and some end-of-year money ideas to prepare you for 2024.
Beef? Goose? I thought it was turkey.
Register now at realinvestmentadvice.com. Talking Turkey about your money with Ratliff and Rosso.
Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
All right, get ready to wrap up the show this morning. WeWork. Remember that story about WeWork? This was the young kid that was going to innovate and rejuvenate the office rental space, and all he did was build basically a Regency office center and made it look fancy. And then
It was pretty nice.
It was nice, but it was no different than any other place that you go to rent an office for the day. There was nothing special about it, but he had created this whole facade around this, this was during the disruptive phase, right? We're going to disrupt everything. And so this was supposed to be the new disruption in office rental space. Of course, that whole thing went belly up because at the end of the day, you need people to rent office space. And he got way over his skis in terms of a lot of problems. He made a lot of mistakes. It was a great idea, but it was investors threw billions of dollars at this. Anyway, they have now filed for bankruptcy. So,
I think
actually they've filed the plan for bankruptcy. So.
Yeah, I think they had like beer on tap. That probably was their first problem.
Yeah.
Right? Companies decide, we're not real productive here. In fact, I had a WeWork space for a bit, and I can't recall if they had that in there or not. I know they had root beer, but I'm pretty sure they did.
Yeah.
I never partake.
But this was a company worth $47 billion at one point. So anyway, it was supposed to be the next great thing.
Well, I'm sure it was until COVID happens and everybody decides they're going to work from home.
That certainly didn't help. But no, I mean, it was never going to work because the valuation on it, you didn't have enough. There was never enough people. Again, because you have this was one of those interesting things where you actually have a competitor that you can go analyze that does exactly the same thing you're doing and look at their valuations versus your valuations. And it was never going to work out. But it was an interesting idea, The
interesting thing about that is that I don't think they really owned any buildings, so they were renting from their competitor more or less, and then subletting it from there, subleasing, and so I mean, I think maybe a lot of people liked it because if they traveled for work quite a bit, you could always find another WeWork that you could go and use. A lot of reciprocity.
Do the same thing with Regency, and every other one. Yeah, that's the point though. There was nothing.
Different.
It's nothing different. Yes, you could rent a room on your app. It had an app that went with it, which was cool, but the basic business model wasn't disruptive. So anyway.
So they filed for reorganization or are they liquidating?
Well, I'm sure it doesn't say, but it's probably going to be reorganization as usual. They still have a lot of debt that they're carrying. Chapter 11, they are filing for. Okay. So not Chapter 7. Yep. Chapter 7's the full. We're done.
Yep. See you later. Sayonara.
If you make it to Chapter 11, you're okay. So just getting ready to wrap up the show this morning. Again, be sure and get by the website, realinvestmentadvice.com, and click on the link to get registered for this weekend's Candid Coffee. And I'm sure that Janet Yellen is going to make an appearance. I'm sorry, Danny. Just in advance.
I don't know. We're going to try to maybe see if Janet Yellen sleeps in.
The only way that's going to happen is if you gag him.
Stranger things have happened, I'm sure.
So lingering inflation, this is, the big conundrum. Everybody is, concerned about inflation. It's 3.7%. And you got to remember, again, this is what we were talking about earlier, is, keeping data in line with reality, right? Yes, inflation's ticked up here. Nothing goes down in a straight line. It takes time. And if you're going to roll the ball down the hill, it's going to bounce on the way down. It's just, that's the way data works. And you get to periods where previous comparisons were low. And so you get a little bit of an uptick in data. And then you're going to get to this period where data upticked and then it's going to go down again. So that's just the way it works. But we're down from 9%. So we've come a long way in bringing down inflation. But Lance, it still cost a lot to fill up gas and buy groceries, and candy was up 20% this year for Halloween. Yeah, I get it. Now, a bag of Reese's, not as many Reese's, and they charge you more for it. So, I get it. The Fed doesn't want deflation, as we talked about before. Prices aren't going back to where they were. You're not going to see $2 a gallon gasoline anytime soon, and you may not want to, because if you do, we're going to be in a recessionary environment. So yeah, we'll get lower prices when you get into a recession, but we're not there yet. And the Fed doesn't want recession. They want inflation. They want 2% inflation. So whatever you paid for in January is going to cost you 2% more come next January. That's their goal, right? They want inflation over time because that gets you economic growth. But, this is the challenge, as we talked about before, is that you talk to most people right now, their attitudes are very sour. And, a recession's coming and inflation's killing everything and interest rates are high. I can't afford anything. I get that, right? Danny and I understand that. But, this is that part of the cycle that we've got to just navigate our way through. And that's the challenging part, because nobody knows for sure when or even if we'll have a recession. Are we going to have a recession next year? There's a decent probability we will. And a lot of indicators, like Danny mentioned earlier, inverted yield curves and economic indicators all suggest that we should, leading economic indicators is a good example, all suggest we should have a recession next year. The lag effect of higher interest rates all suggests that we should have an economic downturn next year. There's no guarantee that's going to happen. And that's the challenging part. So this is the hard part about managing money and managing your portfolio is making decisions today about something you have no control over in the future. That's the hard part. Danny?
Well, I think people are frustrated too because we've seen years where we haven't gotten this prolonged bull market, so to speak, where you get a good year, a bad year, a good year, a bad year, or maybe something decent halfway in between.
Yep.
I mean, even look at 2020, you have that huge correction in March. And then we see markets run up, which was, not primarily, a lot of it was meme stocks, right? Reddit, things that most people did not want to touch unless you're, Vegas money. Things that were, look at Tesla that year. It was priced to be the only auto manufacturer and battery maker in the world is what the market cap suggested in that year. A lot of people profited from it, but then a lot of people wrote it back down as well. And so we always have to be cautious with, how we invest, what we do. Don't put everything in one basket, meaning that we're not going to go all in on one stock or just one asset class, because I think that's where, people get in trouble. And, I've talked to a lot of people like, well, we should have bought the Qs in January. Okay, great. And we had some of that, when we're managing money, and I think most people did, but nobody had only that, unless you were just investing in that particular space. And even then, I visited with somebody at a baseball game not long ago, and they were like, "Hey, what are you guys doing? How do you feel about the markets?" And so, well, what are you doing right now? I said, "Well, I was invested in tech in 2022, wrote it down, took it on the chin. I'm still in tech. I know it's the one place it's performing, but I'm still not back to even."
Right.
And I think,
and neither are the markets.
Yeah. Yeah. And so that, I think, is what is extremely frustrating. And then you see the bonds, and then you look at cash, say, okay, we can get paid a little bit on cash. And so, like you mentioned, we think all the indicators are suggesting that things will slow down here in the future. At what pace? When? That's what nobody knows. And does something occur that helps avert that? Because we've been seeing that. I mean, we can make an argument for the last several years, we should be in a recession, even prior to COVID.
Yep.
And here we are. I mean, we've got what I don't even think you like to call us a technical recession, right?
Right.
We have 2 consecutive quarters of negative GDP.
But we had it.
We had it.
Yeah.
But NBER did not say, hey, we're here.
Right, because what they need is they need, the National Bureau of Economic Research is looking for 2 negative quarters, but they need confirming evidence of that. And the employment report never gave them the confirming evidence. So that's why they never declared that as the recession. But, it also took them 16 months from 2020 to come back and declare February, March, and April as a recession, 16 months later. So when did we have these 2 negative quarters?
Yeah, what's it, Q1 and Q2 of last year, right?
Yep.
Yeah.
So 16 months forward, I mean, maybe we're getting to the point where they now go back and backdate. I don't think they will because the employment numbers were strong. I'm just saying is that lag, and this is always the problem with the data, is the lag effect of this data and the revisions that come. And again, we revise data annually and then every 3 years. So we're just now about to get to the point where we're going to go back and revise the data in 2022. So we may see that, oh, by the way, we didn't have negative growth in the first 2 quarters of 2022, or they revise it and say, oh, really, it was a lot worse than we thought. And yeah, there was a recession there. So, this is the problem with data and looking at this trailing data and then making assessments about the state of the world and the state of your portfolio based on this. The reality is that earnings drive prices ultimately. Right now, earnings estimates are being ratcheted up. If these ISM manufacturing indexes and surveys, which are now turning up over the last couple of months, and we talked about this previously, I wrote an article about it, talking about that we had such a big decline in these service and manufacturing indexes, they were going to turn. And so they are now turning. Earnings will turn with those indexes because of activity happening in the economy. All of a sudden, this is going to shoot a nail right through a lot of these recession calls and say, well, how did we avoid a recession when we had all this other stuff out there? You also have a lot of stimulus still sitting in the economy. Inflation Reduction Act, the CHIPS Act. There's a lot of money. M2 as a percentage of GDP is still extremely high. And that's something that worth paying attention to. Danny, last words.
Hey, join us this Saturday, November 4th, realinvestmentadvice.com. Go sign up. It's going to be 8 a.m. Central Time. Love to have you guys there. Submit questions. This time is designed for you guys. We created Candid Coffee during COVID to simply just kind of do like office hours, more or less. You have a question, we'd love to answer it. So go ahead and send those in. We'll have things prepared, and look forward to seeing you guys there.
All right. Have a great day. See you back here tomorrow with Michael Leibowitz to talk all about the Fed. See you then.